The Trump administration will impose 104% tariffs. This is the latest in a round of attacks that could have massive implications on the world stage.
China is striking back. In just the last hour, Beijing announced it is now slapping new retaliatory tariffs on all U.S. goods by an additional 50%.
What if Trump isn't wrong, but testing China's limits in a high-stakes strategic game? Welcome to the Strategic Flow, where each analysis reveals the behind-the-scenes of global power. Amid headlines shouting panic and markets in decline, a less impulsive reading is starting to emerge among economic and diplomatic analysts. What if Trump's most controversial decisions in the trade war are, in fact, part of a pressure strategy to force China to expose its limits? In this episode, we investigate an alternative scenario, widely debated in strategic circles, the possibility that the White House is intentionally provoking an escalation, even at the risk of a massive sell-off of Treasury bonds by the Chinese, as a way to redefine the rules of the game, even if it comes at a high cost in the short term. On April 9th, the White House announced the temporary suspension of a large portion of tariffs applied to U.S. trading partners. The move, initially interpreted as a sign of de-escalation, boosted Wall Street for a few hours, but the calm didn't last. While easing certain external pressures, Trump sharpened his main focus, China. Far from signaling a retreat, the measure was accompanied by an aggressive jump in tariffs against Beijing, from 104% to 125%. China's response was immediate. Retaliatory tariffs rose to 84%, signaling that the game was far from cooling off. However, there's a less obvious, and possibly more strategic, point in all this maneuvering. For some analysts, this escalation doesn't represent panic, but a deliberate attempt to push tensions to the maximum to test China's resilience. By applying direct pressure, the Trump administration may be seeking to provoke a reaction that reveals where Beijing's financial and political limits truly lie. And that reaction seems to have arrived. According to sources close to the Chinese regime, a powerful card has entered the discussion, and it goes beyond tariffs. It's the threat of using the U.S. Treasury bond market as a counterattack tool, a move that not only raises the financial cost of the conflict, but puts Wall Street face-to-face with a different kind of vulnerability. Recent reports indicate that China may be on the verge of activating one of its quietest weapons, selling part of its U.S. Treasury bond reserves. The response would come directly after the tariff escalation imposed by Washington. We're talking about a financial arsenal of between $900 billion and $1.1 trillion. If that amount starts flooding the market, the impact will be immediate. Higher interest rates, a pressured dollar, and volatility on Wall Street. The term commercial nuclear bomb may sound exaggerated, but it reflects the gravity with which analysts view this potential move. For the Trump administration, it's not just a threat, it's a real test of U.S. financial stability. For a long time, the idea of China selling U.S. bonds seemed unlikely, but the new phase of the trade war, which began on April 2nd, 2025, has turned that calculation upside down. Reports on social media and in the press indicate that Beijing has ordered its central bank and banking sector to reduce exposure to the dollar. At the same time, there are signs that some Treasury bonds have already started to be quietly offloaded. For analysts in Washington, this set of moves points to something bigger. China may be preparing to play its last and most powerful card against Trump's tariff escalation. If China actually sells a significant chunk of U.S. bonds, the effects would be immediate. The cost of debt would rise, the dollar would lose strength, and inflation could spiral out of control. That's why the term commercial nuclear bomb has spread so quickly, because at the heart of Wall Street, this scenario isn't just symbolic. It represents a real systemic risk. A massive sell-off could trigger panic, and few markets are prepared to absorb that impact without instability. But here's a hypothesis few consider openly. What if this kind of pressure is precisely part of the American strategy? By provoking China to this level, the Trump administration may be forcing a reaction that helps map, with precision, how far Beijing is willing to go. A risky game, but one that could yield valuable data for future negotiations. For decades, China has been one of the biggest financiers of the U.S. government, reinvesting its trade surplus into U.S. Treasury bonds. This dynamic quietly sustained a financial interdependence that benefited both sides. But the landscape has changed. With U.S. tariffs reaching 125%, there's a growing perception in Beijing that this relationship has reached its limit. Rumors in the media suggest that Chinese banks have been ordered to cut back on dollar purchases, which in practice hints at a plan for gradual decoupling. For analysts, the message is clear. China is signaling that it may slowly break with the most sensitive pillar of the American economy. And if this is indeed part of a strategic response, it's not just a reaction. It's an attempt to redesign the global financial architecture. Market signals leave no doubt. Something has started to shift. British reports point to an intensification in the selling of U.S. Treasury bonds. And the effects are already spreading. Rising yields, instability on Wall Street, and a growing perception that the epicenter of tension is now financial. The White House's plan to erect a tariff wall seems to have triggered a quiet but profound response. What began as a commercial tug-of-war may be turning into a battle for control of confidence in the system. The threat of a Chinese bond sell-off isn't new. For years, it has hovered over debates among analysts without ever materializing. The reason? Simple. If China sells too much, it tanks the value of its own reserves. This trap is well known. The interdependence between Beijing and Washington is so deep that a direct financial attack tends to result in losses for both sides. It's a game with no clear winner, only calculated damage. But the difference now is the context. If the rhetoric escalates and actions persist, even what was once unthinkable could become a real card in play. With the approach of fall 2025, the tariff escalation has reached a new level. China announced additional tariffs of 84% on American products, a move that signals not just retaliation, but an imminent rupture in trade ties between the two powers. What was once a contest for advantage now looks more like deliberate disconnection, and when economic channels start to close, the geopolitical cost multiplies. Trump claims he's ready to negotiate, but says he's waiting for a phone call. On the other side, Beijing responds, "We'll only sit at the table if tariffs are reduced first." It's a classic economic war standoff. Neither side wants to be the first to blink. Meanwhile, the possibility of China retaliating on the financial front with a Treasury bond sell-off is moving from theory to near reality. The big question lingers. Would China really play this card? Selling bonds on a large scale would also hurt Beijing's own assets. That's undeniable. But in a prolonged trade war scenario, where interdependence starts to crumble, accepting controlled losses could be part of the strategy. For some experts, that's exactly where the danger lies. If China decides the cost is worth the deterrence, the American financial market could be put in check, even without a direct shock. Some analysts argue that the excessive use of tariffs by the U.S. has pushed China toward a more forceful response. But what Beijing is signaling now may go beyond simple retaliation. The directive for Chinese banks to cut dollar purchases could be part of something bigger, a structural reconfiguration of its reserve policy. The push for alternatives to the dollar, like strengthening the digital yuan, shows that Beijing is thinking long-term. In this context, the threat of a bond sell-off ceases to be just a tactical gesture. It becomes part of a broader plan to reduce exposure to American financial hegemony. Even before any official move from China, American markets have already started feeling the pressure. Rumors of a potential Treasury bond sell-off have shaken investor sentiment. With the new round of tariffs, funds around the world, which traditionally saw U.S. bonds as a safe haven, have started unwinding their positions. The fear is clear. If China dumps its holdings, interest rates could spike, inflation could spiral, and bond values could plummet. The mere threat is already reshaping global investor behavior. The most visible side effect is already hitting the currency market. The tension from bond sales and tariffs has started to pressure the dollar's value, while Trump maintains his tough rhetoric, guaranteeing that the U.S. will win the trade war. Voices in Washington signal that there's still room for negotiation with Beijing. This duality creates uncertainty. The market hears strength, but also detects hesitation. And in a high volatility context, this ambiguity is fuel for more instability. If China does start selling bonds on a large scale, the impact on the U.S. financing structure could be immediate and profound. Economists warn that this scenario could force the White House to reassess its position quickly. But for now, neither Washington nor Beijing shows any willingness to back down. The standoff persists, and the longer it lasts, the greater the risk of permanent fractures in the global financial system. For many analysts, a bond sell-off is China's last high-impact card. But it's far from the only one. Beijing is already investing in alternatives, like trade in local currencies and strengthening digital currencies, including the digital yuan. These are pieces of a diversification strategy aimed at reducing dependence on the dollar-dominated system. Still, in Washington, the consensus is clear. If this card is played, even if not decisive, it could trigger a shockwave of significant proportions in the American economy. On social media, the narrative that Trump is in panic mode has gained traction, fueled by fears of a large-scale Chinese sell-off. Within Congress itself, voices are starting to grow louder. If China unloads its bonds, interest rates could soar, and the country could slip into recession. For these lawmakers, pressing forward with the tariff war could be akin to shooting themselves in the foot. But even under pressure, the White House keeps betting on escalation, perhaps counting on the bluff being stronger than the bullet. Not everyone agrees that a Chinese bond sell-off would be devastating. The U.S. debt market is massive, and proportionally, China's holdings represent a significant but not dominant share. It's estimated that Beijing holds between $900 billion and $1 trillion in Treasury securities. If it dumped everything at once, yields would spike, the dollar would wobble, but the damage wouldn't be one-sided. China itself would see the value of its remaining assets shrink, while its dollar reserves would be depleted. In other words, it's not a bomb. It's a double-edged sword. There's also a subtler, perhaps more effective possibility: selling bonds in controlled doses. According to economists, this signaling would be enough to raise yields and stress markets, without China needing to exhaust its reserves. It's a strategy of progressive deterrence, closer to a message than an attack. But even that is already sparking reactions in Washington. The Trump administration has made it clear, if Beijing moves in this direction, financial sanctions could come into play. Beijing is also watching what happened to Moscow. After the sanctions and asset freezes imposed on Russia during the Ukraine war, China began to take more seriously the risks of keeping reserves concentrated in U.S. assets. The response? A gradual reduction in dependence on Treasury bonds and a search for alternatives, including local currencies and assets less vulnerable to sanctions. In the long term, this move represents more than a one-off reaction. It's a clear attempt to chip away, step by step, at the dollar's hegemony and the U.S.'s structural power in the global financial system. On social media and in financial forums, a perception is gaining ground. If the trade war drags on, the impact will be global: slower growth, higher inflation, and shrinking demand. Some analysts suggest that, in this scenario, China could even come out stronger. A capital flight from the U.S., triggered by bond instability, could open space for Asian markets to attract investment. The big question is, would this advantage be sustainable, or just a reflection of a systemic collapse in progress? Even with the temporary pauses announced by Trump, markets remain on edge. The epicenter of instability is still the Treasury bonds. According to Reuters sources, internal analyses indicate that China has historically seen these bonds as a safe haven for its trade surplus. But that paradigm is starting to crumble. With worsening relations, what was once stability has turned into geopolitical risk. And for a country like China, keeping reserves in an asset vulnerable to American political will is no longer an obvious choice. The question dominating the backrooms of Washington, Beijing, and global markets is straightforward. What happens if China actually attacks the U.S. bond market? But this unease isn't exclusive to the U.S. Other major holders of American debt, like Japan and European Union countries, are starting to wonder if they'd also be dragged into this turbulence. If yields spike and the dollar wobbles, international financing flows could shift, and in that scenario, the U.S. would cease to be the safe haven. Global investors might start looking to new centers of gravity. The tension is no longer bilateral. What began as a trade war between the United States and China is now reverberating across the entire global economy. The question looms: are we on the brink of a new systemic crisis? Historically, trade shocks combined with turbulence in credit markets have led to deep recessions, like in the 1930s. Today, the context is technological and globalized, but the risk remains. And no one in any major financial center is treating this scenario lightly. Trump says he's waiting for China's phone call. Beijing responds, lift the tariffs first. The negotiation table exists, but it's empty, frozen by mutual demands that cancel each other out. On social media and in diplomatic back channels, the doubt persists. Is Trump bluffing, or does he really intend to force a reduction in the trade deficit at any cost? Meanwhile, the threat looms. If the standoff continues, China might indeed play its most aggressive card, the U.S. Treasury bonds. The big question now isn't whether, but how China would use its card. A partial release, billion by billion, day by day, would already be enough to pressure interest rates, devalue the dollar, and shake the U.S. financing structure. A full-scale move, though risky for both, would have the power of immediate impact. Here, deterrence works as much through the gesture as through the threat, and the market knows it. Meanwhile, Washington walks a tightrope. Trump doubles down on tariffs, but social media and members of Congress warn pressing forward could spark side effects within the American economy itself. And the internal debate is starting to shift in tone, not about who will win, but how much winning will cost. At the same time, China accelerates its diversification. The digital yuan, trade agreements in local currencies, and the gradual reduction of dollar exposure reveal a deeper strategy, not just to respond, but to reshape the financial system that currently favors the US. This is no longer about a counterattack. It's a remodeling in progress. The global market is facing a new kind of war, where the missiles are silent, but the impacts are devastating. If this kind of analysis helps you understand the world behind the numbers, consider leaving a like and subscribing to the channel.